Let's talk for a minute about reserve banking. In the early days, the banks that operated in the United States were 100% reserve banks. That meant that you put your money in the bank, might be in the form of gold coins or whatever, you put your money in the bank, and they would keep the money for you in the bank. They wouldn't loan it out to other people. The bank owner might loan out money, but he would never loan out the depositor's money. But if they don't loan out the money, how does the bank make money? How do they make a profit? Well, they charged a fee, a security fee for taking care of your money and protecting it. And that meant that they would then give you a note for that money. And you could take that note and travel to some city, and you would then purchase some cattle in that city using your note at the local bank. And then you would be able to travel back with the cattle, and you wouldn't have any money involved. And then that bank would use Wells Fargo to take the note back and have the gold transferred back to that bank for its depositor. So the money was 100% reserve banking. And that's how it operated for many years. And then they came up with the idea of fractional reserve banking. Now this meant that they would only keep a percentage of the money you deposited in the bank. So let's suppose you deposit $1,000 in the bank. And let's suppose that that bank has 10% reserve requirements. That means they could loan out $900 to other people. Now those other people are going to use that money, and eventually it's going to be redeposited by someone in the bank. And when it is, that money then is deposited, and the banker takes $820 of that money, or $810 of that money, and loans it out to somebody else. And now that $810 moves around, it comes back into the bank again. And then 90% of that goes out, and it comes around, and so forth. And so the question is, how much of that money then becomes new money? In other words, that $1,000 is creating new money by doing this with the money multiplier. So at a 10% reserve rate, how much is it increasing the money supply? Well, for this we use the money multiplier. And the money multiplier is very simple. It's 100 over the reserve rate. So if it's 10% reserve rate, it's going to increase the money supply by 10 times. So it turns $1,000 into $10,000. A 20% reserve rate, 100 over 20, would increase the money supply by 5. So the $1,000 would become $5,000. And so as you can see, reserve banking has tremendous impact on the amount of money that's in circulation and used by the public.